This lesson will be on PDRA metrics. PDRA simply means premium to discount arrays. And for instance, if we are bearish and price pulls back into premium, we want to be selling shorts within any area in price that has these levels that you see here. So if you are bearish and price pulls back to premium, the first level that you may see in premium may be the bearish mitigation block. If you don't see that, you may see a bearish breaker. If you don't see that, you may see a liquidity void. You may see a fair value gap. You may see a bearish order block. You may see a rejection block. Or price can completely go above the old high before it continues to sell downwards. The same thing if we are bullish and price pulls back to discount, the levels that we may want to be part of the move to buy higher will be these levels that you see here: bullish mitigation blocks, bullish breaker, liquidity voids, fair value gaps, and bullish order blocks, rejection blocks, and then the old low. Price can completely go below the old low that has formed and then reverse and continue higher. So these are premium to discount arrays or institutional reference points in premium and in discount that when price pulls back to in a trend, we can engage price to be part of the prevailing trend. Now these concepts are not mine. They are owned and produced by the Inner Circle Trader, the ICT, and so all credits to him. So the first PDRA that I'll discuss is the fair value gap, which is also known as the FVG. So let's go to fair value gap. So when you say a fair value gap, it is an area in price where market did not deliver price efficiently. Okay. When we say efficient price action, it means that price has delivered price to both buyers and sellers. But in a case where market decides to deliver price only to buyers or only to sellers, then we say that price has been delivered inefficiently. Okay. So market in those areas does not deliver price efficiently. It only delivers price to one side of the market participants. It can be delivered only to sellers or only to buyers. Okay. And you know that the market involves both buyers and sellers. And so in a case where price is only delivered to buyers or only delivered to sellers, you say that the market has not delivered price efficiently. And so normally the algorithm would reprice into that area to balance price to both buyers and sellers. So for instance, if price delivered price to only sellers, okay, normally price the algorithm will reprice back to that area to offer buyers opportunity so that the range will be balanced. So you are saying that fair value gaps or FVG is a good indication of a strong trend, and it's an area where we can anticipate to engage price when traded to. So in a market where the algorithm is delivering price to only sellers, it gives us an information that price actually wants to deliver price lower, and the prevailing trend is strong because it's leaving behind fair value gaps. And so if you want to use a fair value gap for entry, you can go for the open or at the start of the fair value gap, or you can use the 50% of the fair value gap. And the 50% is also called consequent encroachment. So let's look at some chart examples. There's an example for a bullish fair value gap, and this is how you mark your fair value gap. It's a 3-candle pattern where we have the first candle's high being traded through, and then the third candle fails to fails to fill the range of the second candle or the middle candle, you see that for instance, you see that this candle here, it filled the range of this candle, so there are no gaps within. But if you look at this price range, you can see that this candle's wick ended here, and the next candle was a large range candle, and then the candle that opened next failed to fill the range of this candle, and so it opened here, gave this low and close here, leaving this wide gap inside here. So if you take this red line, which is marked from this candle's low, and then this red line, which is marked from this candle's high, the gap or the range in between is what we call the fair value gap. Okay, so that's how you mark it. For a bullish fair value gap, previous candle's high to the third candle's low. Okay, and then the middle of the candle that you see here, the range that is left here is your bullish fair value gap. And as I said, normally the algorithm will reprice back into the range to then continue the prevailing trend. So we are bullish, we have a market structure break, we want to engage in buying. As price pulls back to such an area, we can buy from this area to take price higher. As simple as that. And yeah, one more example of a bullish fair value gap. It's marked from the previous candle's high to the third candle's low, the range in between this candle's high and then this candle's low. That's your fair value gap. This is a bullish fair value gap. And so normally price will come back to the range to fill it. At times it can fill it to 50%, as you see here. Price do not require that it will fill it completely all the time. At times it will just wick into it and move away, like you see here. So when it fills the 50% of the range, you say it has filled consequent encroachment of the fair value gap, or it has filled 50% of the gap, and it moves away. So for a bearish scenario, this is how it looks like. Previous candle's low to the third candle's high. Okay, so from this candle's high to this candle's low, this entire range is your bearish fair value gap. And you can see that price only delivered sellers or only gave sellers the opportunity in this range. There was no buying opportunity in this range. It was only sellers that were given the opportunities. So normally buyers will be given opportunity back into the range, like you see here, before continuation down. Okay, so one more example. This candle's low to this candle's high. If you mark it as I've done with these red lines, this entire range is only sellers that were given the opportunity. So we said that market was delivered inefficiently, and so the algorithm will reprice back into the range to offer buyers an opportunity in that range. That's why you see candles buying back to the range. And then this one, the range or the fair value gap was filled completely with this wick. So we say this is a full fill. If it filled only the 50% or halfway, we say it has filled consequent encroachment. And so price came back to fill the gap completely and then reverse lower. Okay, so we are bearish, we want to be looking for sales. We have a break in market structure here. As price pulls back into this premium area, which is the fair value gap that we see here, marked by this candle's low and this candle's high, we can engage to buy to sell to take price lower.